Let's move down to this corner. Where do central banks come in? Well, in recent years, as these institutions have been on shaky ground, they've become more and more dependent upon central banks. And typically what would happen is they would take some of these bonds that they've bought, so think a U.S. Treasury or an Italian bond, they post it as collateral at a central bank, and then the central bank basically gives them money created out of thin air. Where we're running into problems, when we're going to move down to this area here, is when you get a small move in interest rates, you can go from a situation that's stable to a situation that's somewhat of in a crisis relatively quickly. And let's use a couple of examples to do that. One example would be an adjustable rate mortgage, affectionately known as an ARM. If someone, let's say a middle-class, hardworking American, has an adjustable rate mortgage, as we know from the last crisis, when interest rates go up, it means when they try to service that mortgage, they make principal payments and interest payments, a small move in interest rates makes this payment go up, which means it makes their income from their family to their spending start to get out of balance. And again, as we know from the housing crisis, if interest rates tick up just a little bit on those adjustable rate mortgages, homeowners can get into trouble quickly. The second example that we've seen more recently with a government is Italy recently was paying roughly 5% when they went out to these public debt markets and did debt auctions to finance their spending. At 5%, they were fine. You weren't really reading a lot about Italy. When the interest rate that they had to pay on the new bonds that they were issuing moved up 100 basis points, which is just 1%, we went from Italy being fine to Italy being in a crisis. Why is that? It's because when you get this small move here, when you have a lot of debt, the interest payments that you have to make going out into the future basically become unsustainable. They start to get extremely large, and if you've already got a mismatch here with spending and revenue, when this interest payment starts to rise in the future, it makes this mismatch even worse. So when you get into that situation, so think Italy running into a problem when their bond payments hit 6%, then it also becomes questionable the assets on the balance sheets or the books of the banks and the financial institutions. They own those Italian bonds, and the central bank also has them as collateral on their books as well. When those assets become impaired, that can tend to create a little bit of a problem. And what is the problem? Well, the problem is it's very difficult to sell new stock when buyers are concerned about bad bonds that you have on your books. Deposits may even flee from banks or financial institutions. So more recently, think on Wall Street, MF Global had exposure to sovereign debt in Europe, and customers basically fled, which becomes a problem. When you have these bonds on your balance sheet, it's also difficult to go to the debt market and sell a Goldman Sachs bond or a Bank of America bond to raise capital. So what happens is this portion of the credit system becomes somewhat impaired. What's happened in recent years to make up for this impairment is central banks have upped their game a little bit and become more and more involved, which is obviously troublesome. One example of that recently is Europe went from doing shorter term loans here to banks and financial institutions, and they changed the term of these loans to as long as 3 years. The market has interpreted this change to a 3-year term in two different ways. Some market participants look at it as a backdoor bazooka, and let's go through that situation first. The way a backdoor bazooka would work, it would be massive money printing. What you would get is the firms can take an Italian bond, post it as collateral, get a 3-year loan, and then in turn they can lever that money up and use all of those funds, send it to these governments, so send it to Italy, send it to Spain, send it to Portugal, and buy more government bonds. Then in theory, you could take those government bonds and post them as collateral, and the process can repeat itself. Why is it called a backdoor bazooka? Well, if you understand the way that the EU was set up, unlike the United States, the European Central Bank is forbidden legally from printing money and funding governments. The term backdoor comes in because this is really a way, potentially, to get around that problem. This allows the central bank to print money, and the dirty work is actually done by the banks. They're the ones that buy the government bonds. There's nothing in the treaties, at least explicit, that says these central banks cannot interact with these institutions, and then the institutions buy the bonds. Under that scenario, why that becomes questionable is the problem for these financial institutions is that they're currently hampered or cut off from their typical sources of funding because market participants look at these bonds on their balance sheets and they don't like them. So under the backdoor bazooka scenario, what they're doing is increasing their exposure to these questionable debts. So short term, could the backdoor bazooka allow the euro to spike up, the dollar to go down, and the U.S. stock market to rise? Yes, it could, because short term, it does allow these banks to support future government bond auctions. And we already saw that where an auction for Spanish bonds was what's known as oversubscribed. And the theory is that the backdoor bazooka allowed them to do that. If you use the backdoor bazooka as the long-term quote-unquote solution, you're basically saying that the banks and financial institutions will be perpetually dependent upon the central banks and printed money to make this whole thing work. Why is that? Because if they increase the amount of Italian bonds and Spanish bonds on their balance sheets, they're going to be unable to issue stock. People are going to flee the institutions because they're going to have concerns about their balance sheets, and they're not going to be able to sell bonds. Now, another way to look at the recent change to 3-year terms on these loans is that the leaders are prepping for a default. They're trying to grease up the system. So let's say if, no pun intended, if Greece, the country, defaulted on their bonds in the next 60 to 90 days, these 3-year loans would allow the banking system to somewhat function while they're shut out from these markets. And if we go through a cycle of sovereign defaults where you get write-downs in Greece, write-downs in Spain, write-downs in Italy, etc., these institutions could be cut off from their normal source of funding for quite some time, which would make it nearly impossible for these governments to sell future bonds to keep this imbalance going. So you look at this one of two ways, and this is why the markets have been so jittery. If the backdoor bazooka theory is where we're going long term and the ECB is just going to indirectly print money, that means that inflation-friendly assets like stocks, gold, copper, etc., would be in favor as they try to inflate their way out of it. If they're preparing for a default, which is really the way the markets are leaning right now, those are the exact assets that you don't want to own. This is a deflationary scenario, and the investments that do well over here are the exact opposites of what do well under this scenario. What does well under a write-down or default scenario, a deflationary scenario, would be very conservative bonds, cash, and while it may sound a little ironic, it would be the safe haven U.S. dollar. Why would central banks extend the term of these loans to 3 years? What happens here is as these institutions get impaired, obviously they tend to cut back on their lending. let's talk a little bit more about why that is. Well, you've got a balance sheet here with assets and liabilities. The bonds that they have on the books are worth less, and the regulators are telling them that they need to raise capital. They have a tendency to hoard their cash, and then you get the credit crunch situation. And maybe more importantly, when these institutions are not healthy, it has a negative impact on the financial markets. Then, in turn, what you can get is these interest rates that you have to pay in these public auctions can go up even faster, exacerbating the problem. Then you get to a period where you've got an unsustainable situation. And why is it unsustainable? It's unsustainable because long-term the interest rate that they're paying and the interest payments that they have to make going out into the future, there's just a huge mismatch between revenue and spending. There's another reason why it would be difficult for the backdoor bazooka scenario to be a long-term solution, and let's look at that now. Under the backdoor bazooka scenario, the financial institutions take a low-interest loan. So for the sake of conversation, let's say when they post the collateral and get the money, they pay 1% annual interest on that loan. They then take that money and in return swap it for an Italian government bond, let's say, paying 7%. If I bought an asset that pays me 7% and I did it with borrowed money, but I only have to pay back 1% a year, that spread, that's my profit, which means the banks could make a 6% profit. Now, if I have a 6% profit built in, why would I ever go out and make a loan to the general public? Because that spread would be much, much smaller. And the real issue why the backdoor bazooka would be difficult to be a long-term quote-unquote solution is, how do you think the general public and taxpayers are going to feel about central banks and governments once again padding the profits of banks, which would enable them to continue this really unsustainable situation?